Hopefully everyone has survived the first week of non-holidays. Certainly, if you're a stock market investor, it probably wasn't the best start to the week that you've ever seen. Volatility seems to be the name of the game. Investors have decided that they're not really too sure what's going to happen this year. There's a lot of talk about interest rates. There's a lot of talk about oil prices, and but what we like to do is basically just focus on the basics. And um, interest rates are, of course, one of the two things you should look at, and then corporate earnings are the other. The thing with interest rates that are interesting right now is the fact that everyone is expecting interest rates to rise later in 2015. And the reason that's interesting because a year ago everybody was expecting interest rates to rise in 2014, and just didn't quite happen the way investors expected, which is often the case. And the other thing, of course, is when everyone is expecting something to happen, sometimes it happens, sometimes it doesn't, but it's almost always already priced into the market. So there's a lot of investors out there that are concerned about interest rates going up, and it shouldn't be, in our view, it shouldn't be something you discount, but investors have had now, if we go into, I guess, March of 15, had 7 years to concern themselves with higher interest rates. So interest rates have not changed since 2006, I believe, or actually 2008, I think. The pre-crisis, I sort of put the financial market in pre-crisis and post-crisis. So certainly not since '08, and then prior to '08, I really can't tell you what interest rates were doing. The market was strong, so it wasn't a big concern, and that was kind of the dividing line. But certainly for 7 years, rates have basically gone down and hit historical lows a month or two ago, actually, in the U.S. And so now you've got a question: is everybody in the world expecting a rate rise? And if so, what happens when it actually happens? And if we go back to when the Fed decided to not stimulate the economy with bond repurchases, there was a whole lot of nothing that happened when the Fed decided to stop tapering. 2 or 3 years ago, everyone thought that when the Fed would start to taper, the markets would sell off dramatically and there'd be an economic crisis part 2 and a recession. And it was such a complete non-event. It was hilarious. If you look back at all the poor trees that were killed to discuss the events 2 years ago and what actually happened when the Fed started to taper, it was complete non-event. So keep that in mind the next time somebody on TV is telling you to sell everything because interest rates are about to go up. And of course, interest rates don't necessarily make the market go down. Depending on what the economy is doing, the market can do quite well if interest rates are coinciding with a positive economy. So let's get going, and we'll just start. So thanks again. The topic or the title is Dividends Rule, or Dividends Rule and Dividend Rules. So it's just kind of my play on words, but certainly dividend-paying stocks are one of the best things in the investment world. But you have to approach dividend stocks carefully, and there's a lot of misinformation out there. But basically what you want to do is get a portfolio consisting of dividend-paying stocks that grow their dividends. And if you can do that, you really don't have to do a whole lot of else other than put in your time. So we're going to talk about the market. I did that a little bit, what to do after 5 years of a bull market, how to screen for dividend stocks, what to look for, some good signs and some bad signs that we've tried to pick up over the past 30 years. We always like to throw a little dart at the Canadian financial industry and how they impact your investment performance, and then try and tie that into how to build your own mutual fund rather than paying some of those high-priced people in Bay Street 2.5% of your money for the next 30 years. Just build your own mutual fund. It will probably actually be 95% correlated to the super high-priced experts out there that do it all day long, because the Canadian market is sort of very, very concentrated. But I will show you how to do that and keep your 2.5%. And over time, if you invest a couple $100,000 over 20 years, you'll have $400,000, $500,000, $600,000 more in your pocket instead of my friends down on Bay Street. I'll skip the introduction. Hopefully, if you're on this seminar, you've heard of us, but we have two companies, 5i Research and Canadian Moneysaver. Moneysaver has been around since 1981. 5i Research has been around since late 2011. We really launched in 2012, and we've actually now answered 26,000 investment questions at 5i, and those are all in our archives. So we're kind of proud of that. We blew through 20,000 a couple of months ago. So markets are a little weak this week, but really, what's changed? First off, we've learned in our career, my career at least on Bay Street, is to almost completely ignore the first 2 weeks of January in the market. There's so much portfolio positioning going on. There's so many people who are, there's lots of, in the US, of course, there's tax reasons to sell. People wait for the year end to sell, even though they could really do it on December 27th or 28th. A lot of people are on holiday. So the year ticks over. There's a lot of selling going on. There's a lot of buying going on. There's new money coming in. There's investment plan money coming in. There's the January impact on small cap stocks that were sold off for tax loss purposes. They tend to bounce. There's people planning for the year. There's people forecasting what's going to happen. And it's just basically a whole lot of noise in the market for the first couple of weeks of January. So don't worry too much about what happens in the next week or so. But certainly this week proved to be volatile, and we'd expect that to continue for a little bit of time. So I talked about how the stimulus is over. The Fed stimulus is over. And then, of course, but we've got a brand new stimulus, and that, of course, is the price of oil has gone from $106 to $48 in the span of about 6 months. And so this is a situation where it's very, very convenient for the Federal Reserve to see oil go down dramatically. The price of oil going down affects the economy in a major, major way. It's like a $40 billion, $50 billion tax cut, and every single person, every single consumer has more money. Every single company, except for those poor guys in the oil and gas sector, have more money. And so it's a giant, giant stimulus, and it really sort of takes some of the pressure off the Fed. Even if they were at all worried about stimulus ending, they've got a new stimulus. It's a more natural stimulus, and markets are probably going to like it. The other thing that's interesting, and we expect it to continue, is takeovers. Of course, last year we had Tim Hortons, the big Canadian icon, gets taken over. We would expect more of the same. It doesn't matter if you're Talisman Energy, which has got a bid, other companies that, of course, we can't predict which ones are going to happen in the future, but the valuations are very much there for any global player who is not concerned about the short term. Despite the market increase, you've seen a situation where earnings have risen at a faster rate than the market for many, many companies. And if you are a long-term player, a strategic player, Canadian companies are starting to look very attractive to you in terms of the takeover game. The other thing that's happened over the past 5 years is corporate balance sheets have really, really become much stronger. Companies are sitting on cash, they've paid down debt, and now they're looking at what they can do with the debt, or what they can do with their cash. If they want to add debt, corporate debt is very, very cheap. So if you can finance a takeover at 3 or 4%, you can do some corporate moves at that takeover and make it more profitable. It's almost a slam dunk for you to come in and take over some companies at the current valuations that they're trading at. Sure, valuations have improved from their lows in 2008, 2009, but on a historical basis, there's lots of companies that have typically, for the past 50 years, traded at 21, 22 times earnings that are trading at 14, 15 times earnings because of what's gone on in the world over the past 5 years. So fully expect the takeover game to continue. Dividend increases are continuing, and that's another thing that I think is positive for the market. Again, a lot of what I might talk about today is except for oil and gas companies, because of course they're in a different situation. But every other week, it seems, there's 2 or 3 companies that increase their dividends. Sometimes it's a very, very substantial dividend. So around, I think it was the beginning of December, we had Enbridge increase their dividend by 33%. It was just an unbelievable increase for a slow utility type company where they were paying a very, very stable dividend. They were growing their dividend, but then all of a sudden they decided to do a corporate sort of restructuring and shift some assets down to one of their subsidiaries, and bam, they come in with a 33% dividend increase on one of the I don't want to say boring because the stock's been very, very good, but it's a pretty boring industry, and everybody's got 33% more income this year than they did last year from good old Enbridge. So I think that's going to happen in a lot of different companies because the cash flow is there to support them, and dividend payment rates, dividend payment payout ratios are very low. So the valuations are attractive, and then even though you can't see my slide, my last point here is interest rate hikes are probably already priced in. Unless the Fed does something completely wacko and raises rates 2 or 3%, which I can't believe that would even be possible, and everyone's expecting it, and a half a point hike is probably not going to do anything to investor confidence and investor willingness to put money into dividend stocks. So we've had a good bull market. The question is what happens from this point on. So as I talked about, just because the markets are rising does not mean they're going to fall tomorrow. We've seen a lot of doomsayers out in the world saying, oh, there's going to be an economic collapse and it can't be sustainable and the stimulus, et cetera, et cetera. And I kind of just shake my head at that because for the past 30 years, there's always been a doomsayer. And every once in a while, the doomsayers are right and you get a crash or a financial collapse or financial crisis, and there's 2 or 3 individuals that look like heroes because they predicted it. But if you go back in time, there would be 100 predictions of doom over the past 100 years, and every once in a while there's a problem. So I think there's a lot of talk about that, and I think that the statement is something like economists have predicted 15 of the last 6 recessions. So basically, there's always someone on the other side of the table. The question is, do you really need to be concerned about a crash or a problem or a doomsday scenario? And if you go back and look at the only 2 things that matter, earnings and interest rates, the answer is probably not. I can't predict the future, but there's nothing in the world really that is any different than it has been in any other time of the economy and the market. We've had problems before, we've had wars before, we've had terrorism before, we've had oil crises before, we've had low interest rates before. If the Fed had continued stimulus forever, that might have been different, but it has now stopped. And I've seen so many problems in my career that there's always something to worry about, and just focus on what's important, and what's important seems to be okay. The economic outlook is pretty strong. The U.S. economy grew at 5% the last quarter, which is actually quite solid. The U.S. is the strongest economy in the world right now, which is just a complete 360-degree turnaround from where we were 6 years ago. So got to give them points for executing that turnaround pretty well. Company fundamentals, I talked on that a little bit. Payout ratios are low, cash is high, debt has been paid down, business is good, earnings growth continues, margins have improved, and revenue growth is starting to come back. Dividend payers, if you're worried about a market downturn, then a company paying dividends is the best place to go anyway. I'll talk about that in a couple more slides. Hopefully the slides will be working. But you do have to be careful for reaching for yield. Everyone's heard that a high yield is dangerous, and it really is. You do not really want high yields. You want an okay yield that grows. That is far, far superior than a high yield. And be careful about reaching for yield, and we'll talk about that in a few minutes. In a rising interest rate environment, so say you are worried about rates going up, if you buy a company that pays a growing dividend, then your income grows along with the dividend, and you actually have some protection against a rising rate environment. The companies that get hit the most in a rising interest rate environment are those companies that are very, very stable, that don't have the ability to grow their dividends dramatically. Those companies just look less attractive if GICs go to 3, 4, 5%. But a company that pays a 3% dividend and in 2 or 3 years increases their dividend, then suddenly that 3% dividend pays 5% in a couple of years, and that looks quite good compared to some of the GIC rates, even if they start moving up, because of course that stock price will be going up if the dividend's increasing as well. So dividend growers are what you want to have if you're worried about the market, and dividend growers are what you want to have if you're not worried about the market. So it's kind of an easy answer to what you should do. If your slides are working, Lana, this is the next slide. I've got a headline that says, "Be lazy, free money, get free money," and this is really just a commentary about I had to teach a class. My wife's a teacher, so she asked me to teach a class about investing. And the only thing I know about 14 and 15-year-old kids is they're lazy. So I wanted to talk to them about dividends, but I had to figure out a way to do it to sort of get their laziness to work for me. So I went in and said, you know, you can actually do something where you do a little bit of work on one day, and then you get paid money every 3 months for the rest of your life. And not only that, you get annual raises sometimes without doing anything else. You can sit at home, play Xbox, and make more money each year forever. And of course, that actually gets them a little bit interested, and then I try and spin it into a dividend seminar. So it's kind of a trick, but it's actually very, very true. If you do the right amount of homework, you can get paid forever and never do anything else. It's really quite a substantially impressive event. So what to look for in dividend stocks is the next slide. One of the best signals that we found is a company that declares its very first dividend ever. For this, so I want to just segment it out a little bit. There's companies that, like Apple, which was a very large company that investors basically forced them to pay a dividend because they had so much cash. This is really not what we're talking about here. We want to focus on a company that's $200 or $300 million, that's been through a couple of recessions, that's been through some ups and downs, but has been profitable and now believes that they can sustain a dividend, and so they pay their very first dividend. This is really, perhaps if there's only one investment rule I was to tell people, I would say this is the rule that you should follow the most. The first dividend is very, very sustainable. Sorry, not sustainable, very important in terms of the ability to sort of spot a good company going forward in terms of the dividend market. What you need to do, though, is make sure that that first dividend is sustainable. You don't want it to be too high. You want it to grow. So be a little bit cautious on a company that pays a dividend for the first time and it's got a 7% yield. That may be all sorts of things. It may be management just hasn't thought it through. Maybe management doesn't understand that growing dividends is better than high dividends. But there's also oftentimes another reason. It can be very simply maybe the parent company wants money. So sometimes you get a situation where a large company owns a subsidiary and the large company needs cash. And so one of the best ways to get cash is for their subsidiary to pay a large dividend, and it gets flowed up to the parent company. So you got to be careful about it. You can't just say first dividend, that's going to be a great company. It's not always the case, but you definitely want to, you want to walk it through like this. Here's a first dividend. Let's check out this company. Is it sustainable? Is it going to grow? How long have they been profitable? And what are the odds that they're going to increase this dividend over time? You can actually find some very good companies this way for the very first dividend, especially in the smaller market cap space. So look for dividend growth. This is relatively easy for individuals to find. There's lots of websites that can sort of tell you, but if you just go to the company website itself, you can get their dividend growth history. And then we actually answer a lot of questions at 5i about dividend growth and what companies have done with their dividends. What I like to look for is what they've done over time, how much they've grown the dividend, the acceleration of dividend growth. So for example, the Enbridge 33% dividend was pretty important in terms of waving a big giant green flag saying something's going on. If dividend growth is slowing down, that's also important. So it's the growth rate, the acceleration of the dividend. Also, the time between dividend increases. You get some companies that increase their dividend every year, and some companies that don't. So obviously, one's a little bit more consistent. You get some companies that will do it quite haphazardly based on earnings, which is not as good as a company that has steady earnings and does it all the time. So it's the dividend start and the dividend sustainability and the dividend growth rate are the key points that you want to focus on there. So you also need to consider the payout ratio. How much of your cash flow is being paid out as dividends? This is where a lot of investors get confused. They look at earnings specifically, and if a company is making $1 per share in earnings and they're paying out 80 cents in dividends, then they might look at that and say, well, that's an 80% payout ratio. But if you go into the cash flow statement, perhaps there's some things going on with inventories or receivables or working capital, or there's some accounting charges where the actual cash flow for that company could be $1.60 per share in cash, and now suddenly that 80-cent dividend is only a 50% dividend payout ratio. So I do want you to look at cash flow. It's very, very important. I don't want you to ignore earnings. I want you to consider both the earnings payout ratio and the cash flow payout ratio. Um, for some industries, oil and gas, you only need to look at the cash flow ratio because of the way the accounting charges are done on when hydrocarbons are taken out of the ground. There's much greater accounting charges. But look at cash flow and earnings together and consider how much room this company has to pay that dividend. How much cushion do they have? If there was a recession, what would happen to that dividend? If there was not a recession and there was growth, how much could that dividend grow? What percent cushion do they have? Look at the debt to equity. Obviously, a company with more debt has less ability to pay a dividend. The debt comes first. The bank must be paid first. The debentures must be paid first. So in any problem scenario or slowdown scenario, your dividend is not as secure, is not as safe as the debenture holder's interest payments. So you do have to look at that. If a company has no debt, then dividends are really the only thing they have an obligation for, and it's not even a legal obligation. It's at the company's discretion. So the company has got a lot of flexibility if they don't have debt. Interest coverage, if you do have interest, you have to be able to pay it. The one thing that investors tend to forget about this part is the debt maturity as well, and I think this is very, very important. So a company might have great interest coverage. Maybe they're making 10 times as much as they're paying in interest. So if I said to you, this company's, their interest charges are $1 million a year and they're making $10 million, it doesn't sound very risky to me. It doesn't sound very risky to the average investor. But what if I told you that that company was in the oil and gas industry and their debt was $100 million and it was due tomorrow? Suddenly, what sounds like it's not risky becomes a bankruptcy type of situation because of that debt maturity. So you can't just look at interest coverage. You have to look at the overall picture. When is your debt coming due? How is the company going to pay it back? What's their ability to finance if they need to finance? What's their ability to sell an asset if they need to sell an asset if there's no financing available? So this is frankly why we prefer companies with no debt. You just don't have to worry about any of that. But there's not that many that are debt-free completely. So if you want to expand your universe, you have to look at the debt as well. So evaluate the dividend sustainability. Do not buy any company that that's even got a question of whether that dividend can be sustained. Leave that for the speculators. Leave that for somebody else, because quite frankly, when a dividend gets cut, it's a pretty ugly scenario in most cases. So you may think you're getting a deal with a 10% yield, but suddenly you've lost 45% of the stock, and your 10% dividend doesn't look so good at that point. Be aware of the various ways of payout ratios can be calculated. That's important. A lot of companies will use their payout ratio after their dividend reinvestment plan, so they're excluding dividends that are not paid in cash, and of course that makes their payout ratio look a little bit different if they're excluding the actual dividend. These are actual dividends that are paid. They're just paid in shares instead of cash. And with a dividend reinvestment program, investors can cancel those at any time. So we just think it's better to try and standardize that and just look at what would be paid if it was all in cash. And suddenly your dividend payout ratio might be much higher than what the company is reporting. We've seen all sorts of crazy stuff with companies reporting. Some companies will report their sustaining payout ratio, which includes their capital spending and how much they have to spend to sort of keep the company going. Some companies will not use that. Some companies will use, after-tax ratios, adjusted ratios, and so on. So just be careful and just don't assume a 70% payout ratio is really a 70% payout ratio. Depending on how it's calculated, it could be 50 or it could be 100 if the company is doing some fishy stuff.